Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So for the example, I'm going to use the number of 113.13, at least in this slide. 113.13 equals 88.39. And that's just the inverted number. So there are lots of ways to trade options. Today, we're going to talk about being very bearish, but in the context of already owning the spot. So maybe I have a huge currency position. So I would actually take a very bearish position of buying a put or a very bullish position of buying a call, and I would aggregate that already to my currency position. That would sort of moderate that position to be more of a neutral or moderately bearish or bullish position by combining it with something else. So let me go through the features of the ISE FX options. There are options on the exchange rate, the dollar base with 50-cent strike prices. Premiums are quoted in U.S. dollars. They're a European exercise. It means that you cannot exercise them early, but you can always trade out of them anytime prior to expiration. They're cash settled, noon settlement on option Friday at the WM Reuters intraday rate. They're available in conventional equity brokerage accounts, so if you have any questions on that, just send me an email or type me a message, and I'll talk about the brokers. Continuous quotes by market makers, and these are traded at 9:30 to 4:15 Eastern Time. Premiums are multiplied by 100, so if I saw a premium of $2.50, that would cost me for one contract $250, not including my brokerage commissions. So it's just important to understand how they work. Remember, risk and reward is key. So there isn't any one best strike price to buy, 1 month to buy, or even one strategy, but it all is based on, today we're talking about hedging, but again, hedging is great. For those of us that don't want to concentrate on our foreign exchange exposure, we just basically want to ensure that. So that's really the way to look at hedging. Strike price, again, is the price that the contract is based upon. So I can either buy if it's a call or sell if it's a put, of course, if I'm a buyer of that option. So as an example, the 113 call gives the buyer the right to buy the asset at 113 anytime until that third Friday in October, if it's the October 113 call. Now, very, very important in hedging is to think about which strike price do I trade. Do I look at the in the money, the at the money, or the out of the money? And when I just draw little lines there, the out of the money is going to give us, if I take the analogy of insurance, that's going to be the greatest deductible. Because since we're so far from where the exchange rate is today and that out of the money strike price, if I'm hedging, well, then I have a greater deductible. And in the money option is going to have a much lower deductible, but again, the premiums are going to be much higher. So I have more to lose if I'm wrong, but I'm more to gain if I'm right. So you got to think of it in those terms, that the option premiums are greater, but you're hedging more. The at the money is more of a hybrid approach, so I put up a sort of an average amount, if you will, between the in the money and the out of the money option. So it is sort of, as I would say, a hybrid approach where somewhere in between the in the money that would give us a very, very small deductible, depending on the strike price that I select, and the out of the money, which would give me a very large deductible. And the deductible would actually give me the amount of foreign exchange rate exposure I would have. So different months also create different risk-reward scenarios. So if I wanted to actually buy the cheapest in nominal terms, I would buy the shortest dated option. But the problem with that, if I buy the shortest dated option and I want a long insurance policy on my foreign exchange exposure, that probably wouldn't make it. It's not compatible with my goal. My goal is to be hedged for a year. I might want to buy a 10-month option, or even if 12-month if it was available. Why would I want to buy a 1 month 10 or 12 times? That 1 month 10 or 12 times would more than likely be much greater in cost. But the 1 month, of course, will be, if I only look at it from that 1 month time frame, that 1 month would be, of course, lower in nominal terms. So you need to think in those sort of ways that the longer term option will decay less and less per day, and that's what's called the decay per day is called theta. So you need to understand that that's a very important part of options trading, is the theta. How much is it losing every day? But just like any investment, you're not going to just focus on one thing and say, okay, that's what I'm going to look for, because if you get the lowest theta, you're going to buy a 10 or a 12-month option. Maybe that's you're buying too much time. Maybe you don't necessarily need that much time. So you want to sort of think about what are your goals and what are your risk tolerances. Generally, as I said, time means money. So the longer dated it is, the increased cost. How does the settlement work? Well, the great thing is that this is a cash settlement, so you don't have to worry about settling into a future or anything else. This is very straightforward. The option's in the money, then you will receive that amount of money. Let's say if it's in the money by $1, then you're going to receive that dollar multiplied by the premium multiplier, or 100. So you're going to receive $100. Of course, you would have to be long that option, and it would have to be in the money at expiration. So let me give you an example. If I bought the 100 call and the dollar ended up at, let's say, 102, and I didn't sell that option, the 100 call would be worth $2. And if I didn't sell it, I would actually receive 2 points times 100, or $200 per contract. So that is the ultimate settlement value, and that will be paid in U.S. dollars. So that's important. Another important thing. So you need to think in terms of you're going to receive, you're trading in dollars, and you're also going to get paid in dollars, even though that the premiums are based on a relationship between a dollar and something else. At the end, you're going to receive dollars back. And options can be traded out at any time. So if you change your mind, you just close them out anytime the ISE market is open. Options pricing is based on probabilities. So when I'm talking about probabilities, of course, like any investment, all of us want to try to calculate the exact probability. But we all realize that we're never really going to be able to calculate the exact probability. So we come up with ballpark estimates. We use models. The models are sort of neat, although the models never fully replicate reality. So it's nice to know, and I wouldn't want to trade without the model, but I don't want to trade exclusively just with the model, because the model, as I said, is just a model, and it doesn't fully replicate reality.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.